Welcome everyone to the Kendall Report. It is Sunday night. Thanks for showing up. Appreciate it. A number of announcements. Somebody commented we do have a huge week ahead of us, and there's no doubt about that. I would tell you it's probably one of the most significant weeks, just from the standpoint it's going to set up the balance of the year. So everything's going to be decided this week from my viewpoint. Now, going to also go through some long-term forecast and just reminding you that this Thursday night, the video for Friday will be the final video for the year. And I'm just telling you folks, if you want the market grid, all that, all you do is go to thekendallreport.com/indicators, get the indicators. When I get back, you can spend 30 days in the live room and everything will be wonderful from there. So let's get involved. I'm going to be, for the most part, out of pocket, but I will be doing some things as the vacation time unfolds. I've got a couple plans of at least trying to put out some kind of communication on what's going on if there's anything big. I'm, for the most part, going to be off grid, so some things will be difficult, although I do have Elon's internet just got shipped on the way there, so hopefully I can get that set up pretty quick and everything will be online. So make sure also you subscribe to the channel. Looking forward to next year. There's a whole lot of stuff that's going to be going on. I think finally we'll call 22 I don't know if we call it a disaster. I mean, we're down like 10, 12, 14%, seen a lot worse in my time. And we've seen a lot worse in the last several years. So, you know, going back to GFC, this certainly hasn't been anything like that. And I'm going to go through all the details. We continue to see some traction on the intermediate database, lots of stuff going on. So let's talk about this week coming at us. And I am going to do some long-term. I'm trying to set you up for the end of the year as well. All week long, I'll be talking about elements to watch, and especially on Thursday night's video, I'll be going through exactly what you need to know for the balance and try to set up the parameters, trigger points, those type of things. Do my best I can at that. So let's just look back on last week. It was not a very good week. S&P down 3.4, NASDAQ down 4, Russell down 3.4 as well. So not a real great week, and we saw a more weakness than it looked like we were going to have in the beginning. And as I go through the technicals tonight, you're going to see that there's still going to be a problem going forward. The magical 200-day moving average will continue to probably be somewhat of a barrier. And like I said, in the technicals, I'll go through all these details. So let's look at this week. Nothing really coming out. There's a couple of reports. I didn't even write them down. I didn't think they were material enough. I don't think anything's really going to matter tomorrow. We're going to be operating on market sentiment, whatever that is right now. We're really looking at a situation where the best way to put it is there is no trend at all. We're in this sideways choppy range. I know I've been criticized by some of you that choppy is the new down, but we really are within a range. When you look at the markets and you zoom out a little more than a couple of weeks, you'll see we've just been chopping around, you know, really 37, 40, 4,000 on the basis of the S&P, and NASDAQ's got a little more weakness as usual. But we have CPI coming out on Tuesday. That's expected to be 0.4, up 0.4. Year over year is looking at 7.3. The previous one was 7.7. But if we look back at last week's PPI, that came in hotter than expected. So we're really not in a place, I guess, to say this is going to come in weaker. So I think it'll be interesting if it comes in a little hotter like the PPI did. We may build some further expectations. And I'll talk about the Fed and everything here in a minute. But the real pattern that it looks like it's setting up is really more more neutral, some downward bias a little bit in the early mid part of the week, which probably has everything to do with the Fed and the CPI and those things. So CPI coming out, the Fed meeting begins on Tuesday. On Wednesday, we'll get the FOMC decision. I will let you know, excuse me, tomorrow night, whether we're going to do a live stream on Wednesday during the Fed. That's typically what I've been doing. I'll let everybody know I need to talk to people in the live room because we're doing the live room Tuesday, Wednesday, and Thursday this week. So I will talk to the folks and see what the consensus is there. We've already moved the week around, and this is the final week for everything I do in the channel and the live room and the whole bit. So I'm looking forward to the vacation, but it's already have travel anxiety going on for sure. So we go to the Wednesday. So I'll go into the Fed in a minute. Right now, expected 0.5, and I came up with a couple things that I think are going to be really important as we walk toward that Fed meeting on Wednesday to think about. Thursday, retail sales expected up 0.3, and of course Thursday we get the claims. It's 232K. That's been increasing a little bit. The continued claims are at 1.671, and that number has been rising slightly over the weeks. I still think the number to watch there is 2 million. I've seen people tell me this is not what the Fed wants to see this number higher, I think. I think they want to see continuing claims and maybe even the JOLTS numbers, which are sort of bogus to a point, see them continue to decline too. So they're really focused on the employment situation. Of course, we saw the 10-year print down to 340 last week. I remember several weeks ago when I said there's a target for 340 on the 10-year. Probably myself and everybody else felt like, that's probably not going to happen. Well, it happened. And along with a lot of downward pressure on crude and all kinds of stuff. So we've got a lot to cover. I'll do my best to get through this. Probably take me the better part of an hour to get through here tonight. But yeah, so it comes down on Friday. We've got IHS, manufacturing and service numbers. They're not real big numbers that anybody really watches, but that's coming out. But, like I said, if CPI comes in hotter like PPI did, maybe it will build more expectations coming into Wednesday's Fed meeting. But in the end, I don't think they're going to do anything but what everybody thinks they're going to do, which is a 0.5. And I've been talking about this. Let's talk about the Fed meeting. And there's a couple things that, actually one thing in particular I want you to pay attention to. And if you're commenting on this video, I would love to hear what you think, because I've just at the Brookings meeting when Powell spoke, everybody got all bullish and talking about Fed pivot and pause and all the P words that were coming out. There's something that I realized he never mentioned. And there's something the Fed hasn't mentioned, I don't think, for a while, which is QT. Otherwise, are they really selling off the balance sheet? Now, I've done some preliminary looking at the balance sheet, and it doesn't look like they're keeping their promise at 90 per month. That's not happening. It's lucky over the last 3 months if it's around 50. And I talked about this a little bit the other day, is that the people that have been selling the QT has been coming from China and Japan. I think Japan sold about 200 billion, about the same for China. So that's a lot. That's a lot of 90s. So it's interesting. It's almost, and I've talked about this before, there's some concerted effort, but this doesn't affect the Fed's balance sheet, right? They're not doing the runoff. And I would pay attention a lot, and I will pay attention, and I would ask you to as well, to see how much talk is around the QT about the downsizing of the balance sheet. It seemed like it's brushed to the side. They're not really wanting to talk about that. And I don't think there's an opportunity here, because the bond market got really strong, right? So there's opportunity to sell into this. And for whatever reason, it doesn't appear in the last report I saw in the last week, hasn't really looked like there's any acceleration of sales going on with the whole QT process. So just pay attention to that number. The other thing I want to talk about on the Fed, they've come up and they keep pushing this 2% inflation number. And I did some research this weekend trying to look at where the heck did that number come from? Why 2%? And I really couldn't find anything. They actually started that dialogue back in 2012. I guess that would have been under Grandma Yellen, right? So that's just kind of it looks like it's just a random number. And I thought, what if they, with the inflation higher, what if they kind of raise that expectation to 3 or 4? What would that do? If that happened, that would be actually pretty positive, because now to get to neutral would be a lot easier if they were targeting a little higher number. And when the recession comes, it'd be very easy to get closer to 0 and put stimulus in the markets through lower rates under that inflation rate. And there's two countries right now that are still doing QE on the planet, and Turkey is one, and Turkey has the best performing, I believe the best performing stock performance of anywhere, and their currency's held in spite of them doing QE, not QT. The other thing that's happened is Japan is the other one. I mean, they're screaming more QE, more QE. They're going down on that QE situation, but they sold $200 billion worth of bonds. They did some interventions in the yen, and now all of a sudden the yen is stabilized, and even any rallies that happen, they're probably not going to get into really danger zone. I remember we were talking about 151 on the yen and those things several months ago. You folks remember that, and we got there, and then some, and then we backed off. The dollar is looking more and more like there's a top in place, and that we're just setting up another consolidation phase. And that seems to be the theme, at least for the next 2 to 4 weeks, is that consolidation is going to be the magic number. And that big, I'm kind of stuck in this range-bound trend, sideways chop range, just about on everything. We're hitting the bottom end of the supports, and we're not anywhere close to the top end of these ranges. So I'll try to lay those out as we go through tonight's video. But I just think there's some interesting thoughts. I don't think they're going to change their random number from 2 to 3 or even 4. 4 would even be better, because then it'd be way simpler for them to claim they're at a neutral rate. And at 3 and 4, that's not crazy from the standpoint of crushing the economy and doing things. Matter of fact, going back to Turkey has like an 80% inflation rate, and they're doing QE, and their currency's holding up, and their economy is fairly robust. It's very, very interesting what's going on there, especially. And the Japanese have some different challenges, so it's not quite as clean. But the point is that, they've just randomly put this number out there, and if they continue to stick to this 2% number, then maybe we do get a recession, because they're going to have to trying to get everything to normalize at that 2% is going to be a big deal. I just told you the expectation year over year on CPI is actually 7.3. So we're a long ways from getting any kind of neutral rates or anything. Typically, the inflation rate, you would want the interest rate about 5 points, 0.5 over what the inflation is. So that would suggest an 8% short-term rate. I don't see that happening. As I talked about, I still think the terminal rate somewhere 5.2 to 5.5. Still expect to see the yield curve stay inverted. And I see people out there talking about the inversion of the curve and how accurate it's been. It really isn't. It does have a certain amount of accuracy, but it doesn't mean because we get the inversion that things happen. And you have to go back and look. You just can't claim that the inversion is going to cause a recession. You have to look at the other elements, and you can't just go back and put a chart up of these things and expect that this is going to happen because it happened before. every situation. I talk about this every time, like when we get a big decline or rally in a market. They're similar when you're looking at charts, but when you look at the backdrop of what's going on, you'll see that a lot of things are way different than the previous time. So you couldn't compare the recent decline to the GFC, and you couldn't compare it to a dot-com burst. Everyone is different. Charts look similar, but it's different economics that are behind each one of these things. So you have to really pay attention to the dynamics or the backdrop. I just have an old buddy of mine used to say, every time I think I know where I'm at, they change the background. And that's what I'm talking about here. You have to watch for the backdrop in this economy to really look to see what's going on. And sorry, I get a little bit of a rant here, but the whole thing that's happening here is try to find somebody that's not telling you because of the yield curve, it's going to be a terrible 2023. I'm going to show you when I finish on this rant, we're going to go over to the database, and the database is suggesting, that there is going to be stable to higher prices on the stocks. And I'm going to go through the quarterly, the monthly charts tonight. I'm going through the whole gamut. So I know I went on a long run, but this is, like I said, this is a final week. I'm trying to give you content that you can go back and watch when I'm gone. This will hopefully be one of those videos that you'll be able to go back and get some perspective as we go into the final 2 weeks of the year and what's going on. So let's go ahead, take a look at the database and get into the rest of the video. Okay, so I brought up the intermediate database. We're at 49.89. We increased just a tiny bit. We got up 576 buys, 337 sells, a little bit of a rotation, but we managed to push up to 49. And you should know by now that the magical number is 42%. And I've shown you this chart every time that we get here. And I guess just for old time's sake, I'm going to show you that chart again really quick here, just to show you what this really means. And this is what we're looking at right now is the intermediate database. And let me just go over and we'll take a look at this this chart here, which talks about this. This is a 42% level, and I've talked about this before, but I'm going to keep hammering this down because the database is a forward-looking type thing. I'm going to show you a couple elements tonight because, like I said, I'm setting you up for now, this week, and beyond, okay? So what we're looking at here is that 42% gets in there. So the forward-looking part is typically every signal we put out on the intermediate, and I'll show you here what the stats look like, around 200 to 240 days holding period, which is the better part of a year. So all of a sudden we're looking at, December of next year. Now that doesn't mean that is what will happen. It's typically what happens in our database here. What I want to talk to you about is we have stats on all 16,000 symbols, and we can tell you what the normal returns are on the symbol, what the holding is, everything from a modeling standpoint. And that doesn't mean they'll hold all those times, but you would be shocked if you were in Wavetech or any of those and you could see these numbers unfold, whether it's short-term or long-term. And this part of this is telling me I'm having a hard time being, any type of bearish going forward into 2023. Doesn't mean I think there's going to be bull market in an ATH right away, but I just don't think there's a big collapse or decline coming at the moment. The only thing that would cause that is really, I would say, if there was some event that happened that we didn't know about, maybe, I'm not even going to say it, but let's just say Putin gets crazy and pulls a trigger on something big. Certainly there's geopolitical risk out there going on. So this is always a risk all the time, but more so at the moment, especially coming into the deep winter, especially in Ukraine and Russia. it's pretty brutal there at this time of the year and getting worse by the day. So the point is, I just don't see, models can be wrong. We can roll out of these. There can be some kind of big event that causes that to happen. But generally speaking, this is why I always tell you I'm data driven. This is what's going to drive me looking forward on the markets. Now I'm going to go from here, and we're going to go back to the database here. Let me go full screen, and there's a couple of things I want to show you here. Average days long on the intermediate is this over here in this column is 204 days. This is on the optimized. This means the best model for each symbol in the database. And there's right now 15,937. So what we're seeing here is that there's a lot of forward looking right now at the time. Of all the positions that came on, going back to when the database was down at 20% to currently, right now the average is average duration right now is only 19 days, and we're less than 10% through the holding period. The actual returns, the average profit is 31% on these positions. So as we look forward, the current average profit right now is also 0.19. So that's the percent profit fulfilled, and a current average profit is 0.586. And sorry I can't zoom in on this, but this is really the reason why I'm talking about this database like this is the forward-looking part of this thing. And so that's why I talk about the event from the standpoint of once you get these signals, their holding period is suggesting that these symbols will work out and make some money. Now, not every one of them, but typically over 60% of these trades that are issued that have come out will end up to be profitable. It doesn't mean they'll hit their standard deviation or means or standard devs or any of that. Some will, some won't. Some will actually end up being losers. But on balance, about 60% of this is going to happen. And I talk about this all the time. When all you're doing is looking at the output at the S&P, and we cover the S&P and the indexes on this channel, obviously. But when I'm into this database, this is important to understand from the standpoint of looking forward and what the expectations are. And that's what is going to drive me. And then we'll look at the technicals. I'm going to talk a little bit more about this tonight, about using what I call the reverse fundamentals. If the charts are saying one thing, what's going to be the fundamentals to drive that particular situation? So let's go ahead and get into the S&P analysis and the technicals. Okay, well, this is actually the chart I'm showing you right now is a 5-minute chart. And I'm going to walk you up through the 5-minute and just take a look at what's likely to happen. The 5-minute is projecting right now that the price is going to stay stable, maybe move a little bit up. But we go up the scale here and we go to the hourly. The hourly algos are telling us that we're going to right into about the London Open. We should continue to improve. We're still going to be negative, so we're going to be under the 10-period moving average. Is simple. The 1-hour chart, 39.77. We should stay below that number, but it's forecast that sometime during the night, coming into the New York Open, that we're going to see a continued improvement, and ultimately we get positive on PPM1. And if these things happen, those of you have the indicators, you can watch this depending where you are. If you're part of our European watchers early in the morning, when you get in and watch this broadcast, you're going to be able to see exactly what the expectations are building. These algos update as we get actual real values. And so they're going to change a little bit as you go forward. But right now, that's the forecast. What it's also saying, though, is that the PPM2 is going to stay fairly weak, which puts a cap on the market 39.92, and the actual 10-hour moving average is at 39.77. So we should get into a resistance range between 77.92, and if you're watching the market, probably figure it out off the first chart I showed you, which is the 5-minute chart. So let's go over to the daily. We're going to go up the scale from here and start talking about daily, weekly, monthly, and then ultimately we're going to get to the quarterly charts and start to talk about what the end of this quarter is going to look like. So as what we're looking at right now, this is daily. Daily suggests we got some bumps, but on Wednesday, looks like it wants to bottom out. Thursday looks like we're going to improve toward the end of the week. We'll see if that happens. Really, the only news coming out, it's all about Wednesday, maybe a little Thursday on this expectation from what's coming out of the claims and continuing claims. Retail sales comes out. I'm not sure those are material. I think everything will be about the Fed and what Powell says, and can he spin the market at all? So this is the daily forecast is really continuing stable. It's suggesting that we are likely to stay above the 40-period moving average. That's now 39.01. I talked about this last week. That continues to be what I call the primary demand line right now. If it breaks through that, then we have to go and look at the weekly chart, which we're going to next. Looking at the market grid for this for today, we're looking at so far the low has been 56. 54 is S1, so we've already satisfied S1. R1 is 39.81, so we haven't quite printed there, but that R1 number puts us into that range on the hourly chart I just talked about. The hourly chart also suggests once we get not in the middle of the night, as we come back to that, I'm just going to flash back to the hourly, that we should continue to move higher as we go through the session tomorrow. So I think if we had to say anything about the configuration right now, is really what it is that we're looking at probably a little short covering, people squaring up positions ahead of time. If you watch the close on Friday, it was pretty brutal. I think the last 30 minutes or so, we dropped like 30 handles on the NASDAQ. I mean, everything just got hammered. It was like a mass liquidation. And we're seeing, we're seeing a little follow through right now. We're down 8.25, down 0.2. So there's still some downward pressure from that little sell-off that we had on the close on Friday. I don't think it was material. The algos are suggesting we should stabilize here in the next couple days, which puts us into the Fed meeting, right? We look at the algos on the PPM3, they're going to continue to be in trend mode. So that means there is around a 60% probability that we'll be able to remain above that 40-period moving average, 39.01. That's your market. We'll get through it. I'll show you on the weekly charts what the next level is. So let's go ahead and go to the weekly now, and you'll start to see that the weekly says this is kind of the last week. This is where we start to set up the balance of the year, right? So this is kind of the last week that we're going to have a real positive bias as we go through the balance of the last 2 weeks of the year. We'll go in here. So coming in there, looks like we're going to fade. So maybe we'll be seeing a Santa Claus blip, but maybe not. It looks like we may fade. I will do my very best on Thursday night for Friday's video to set up this and just get a better peek into this, at least as we finish off this week, the second week of the year. And we've got the Fed, and we're starting to digest a lot of this data here. So let's go to the next level, because I think it gets really interesting from here, because now we're looking at the 1 month chart here. And the monthly chart actually suggests that on a monthly basis, and of course, each bar is 1 month, right? So if we come into, as we come into January, looks like we're going to see more of a little potential downside on the PPMs. And so this 10-period moving average is going to continue to be some pretty good resistance. And that's right where, around where we're trading right now. If I get the number up here, 40.19, that's going to be very similar to the 200-day and the 40-week moving averages. I didn't mention those, but that is going to be a very similar number. 40-20, 40-30 is pretty major resistance overhead. So it doesn't look like we've got any big rallies coming at the moment, but it does look like what's going to happen is the downward momentum over the next couple months as we come into January, February, this downward momentum on this 10 is going to flatten out. And the 40 is really where the action is at. It's at a 0.68 positive. So that tells you that that 40-period moving average is, which is very similar to the 200-week moving average, is right now at 37.81. And that number is, let me just see what's happening here. Yeah, it's going up only 30 handles per week, and maybe that sets up some risk down to mid 38 handle. I talked about that last week. So by no means are we out of the way of any downside action here. I think there's potentially some short covering, like I said, for a day or two, but it's all about the Fed, and maybe this thing just rolls over. I'll be able to set this up much better after we see a couple of days action this week. Right now, this is a monthly chart. It's continuing to suggest we're burning off downward pressure, but this is the other area that I want you to pay attention to. The PPM2, which tracks the red line up here, all these indicators are coded to the moving averages. So the red line is the 21. That value is at 42.31, and that appears it's going to start to roll over in the next couple of months. So 40. We're just going to call 42.30 is the ceiling on this market. That's a long ways from the top that we had at, what, 48.08. This is the futures, by the way, so not the cash. Slightly different numbers if you bring up the cash. But we should manage to stay, the absolute best case is we'd stay trading below, on extremes above the 10 and below the 21. So there'd be upper range of that 40, 20, 40, 30. If we broke out of that, we could print up into high 41 handle, maybe low 42s, and we should see a rejection from there. But all of the other algos on a monthly are suggesting there is definitely some still major overhead resistance, and I suspect that we're going to continue to struggle here and really stay in this sideways range. And the sideways range right now is between that 40, we're talking 37.81 is the 40 on the monthly, and 40, the extreme in this pattern on the brackets would be 42.30, and the 37.81 on the downside. That's going to be the major range. We could trade within that range, no problem. So we could see a crazy print down. I don't think we get that next couple of weeks. I'll continue to set that up as we get more information, see actual activity, not overnight when everybody's awake and paying attention tomorrow. So we'll get a better feel in the next couple of days, and especially after the Fed, exactly what to expect, I think, for the rest of the year. As I said earlier in the broadcast, is I believe that this week is going to set up the rest of the year. It's going to dominate where people are going to be shifting all of their portfolios. So just to continue this dialogue around this is where everybody, every major fund manager, you name it, is trying to rebalance, trying to think about 2023, how they want to be positioned coming into year end, and all of that, everything from cash levels to what what they own, all of that stuff is being considered. That goes on every year. This is the same game every year. Sometimes you get an upward bias into the end of the month, and sometimes it's flat to down. You may remember, I think it was 2020, we got a huge rally, if I'm thinking right, right at year end, and we got literally, a Christmas rally. That doesn't look like that's the scenario this year. So let's go to the final level here, and let's go to this is the quarterly chart here. The quarterly chart is very interesting, especially from the algo standpoint. We're seeing that even though this PPM1 is declining, it's suggesting, let's see where we are here. This is April. I'm just trying to get a number on this. Yeah, so it's not, so this is what it's suggesting, is that we're going to stay positive here coming into probably April, and then there's a potential for a roll and maybe some downside action. But we should, and I've talked about this, I covered this a couple weeks ago, and there's most likely on the quarterly, the big range there is monster range, 3401 to 4029. There's that 4030 number, which is that 10-quarter moving average. And that average right now is, let me see where it's going here, 1 second. Yeah, that average right now is going up about 70 handles per quarter. So when we come into January 1, this is going to be 70 points higher. It's going to put us at around 40, we'll just call it 4,100. So everything starts to come into that 4030, 4,100. There's a lot of clusters around here that are probably going to indicate that we had that pattern set up. And thanks, Mike, because yeah, I knew it was last year we had. Yeah, so that's awesome. Thank you for that info. Yeah, but the patterns that are set up here, folks, I talk about this angle of attack and this upward slope. This is very relevant across the board here, in that all of this angle, these are the long, very long, extreme long term, we'll call it secular plus on this quarterly chart. There's still an uptrend here. I know a lot of folks are bear market. No, we're still in an uptrend, and it's probably going to take around the first quarter, into the first quarter of 23 to figure things out. Think about it. Well, listen, I don't think the change in the control of the House is significant enough. And certainly if they put McCarthy in and a joker like him in there, nothing's going to change. So, I mean, it's kind of status quo going forward, even with the government. Maybe they do some things, but it's just going to put us more in limbo. And maybe that's good, because no one's going to be able to get anything done. And that might be a good thing, because the less the government does, probably the better off we are. They already did everything they can, and that was even the capitulation of Joe Manchin when he folded his cards and got, 85,000 new IRS agents just to chase billionaires, though, air quotes. Yeah, right. What's the ratio of agents versus billionaires? Anyway, I digress. But this patterns are setting up. It looks like coming into the first quarter, we could still have a generally positive, but the ranges that I just quoted are huge, right? 30, let me put them out there again, because we're looking at 21, 3401, 4029. That's a new low in the pattern. I still am convinced that we've seen the low for this period, and I don't think until after Q1 will we be in position to maybe look at lower prices. I'm really not thinking that we're going to get an all-time new high. And one of the interesting things, going back to my long dissertation on what I was talking about with the database, is the database are individual stocks. So there's going to be a lot of great trades out of there. We just saw some amazing trades out of the first cycle, out of this big cycle in the short-term charts, short-term models. And that was, so we're going to see similar things. So it doesn't mean all the indexes have to go up. There's plenty of stocks out there that there's going to be money made on, and at least keep a positive bias. So and that might be through that first quarter, because all of a sudden that pushes us out, maybe only about 60 from here, 60 to 80 trading days. So the cycle that I talked about in the database is a little bit longer than that. We're going to definitely have a better feel when we get to that point, what things look like. And it'll be interesting to see if these longer term algos have any real relevance. These algos only been around for 4 months. The PPMs, however, are still in a very positive mode. Just reading them without that, we're at a plus 2.11, plus 2.6, and a plus 2.3 on a quarterly basis. These are very bullish numbers on these PPMs, on these 10 quarter moving average, the 21 quarter moving average, and the 40. These are very, very positive numbers. And those numbers aren't, it's going to take multiple quarters to burn off this type of upward momentum. And this is why I continue to say we're still in this longer term bull market. We have not gotten out of that. And it's just going to be a very selective situation. I'm still working on my secret project I told you about. So, okay, let's just talk before we go on to the NASDAQ and beyond. I spent a lot of time so far tonight talking about setting you up for things. What I want to do is I'll try to get through the rest of the broadcast here as fast as I can. And as always, if there's any differences, I don't have really the ability to get these quarterly, some of these charts, I don't have them set up ready to go. So we'll use the S&P as a, we'll just say we'll use the S&P as a guideline for everything else, as a standard for what's likely to happen in relative terms in the stock market. So there's plenty of stocks, and there's a lot of crossover between the S&P and the NASDAQ. So should be able to be pretty good. So let's go on to the NASDAQ. All right, so we'll take a look here at a NASDAQ. We're starting with the hourly, just like before. And it's interesting, I left the Fibonacci targets here, and we have a pivot at 11,829. There's still some upward Fibonacci's that are positive. It's interesting that the hourly, just like we were talking about, looks like into about 3 o'clock a.m., which is, by the way, 5 a.m. New York. These are my local times in Mountain Time. So these are the values that you would expect to see us trade into, these moving average values. And let's just see here. Yeah, so it's still going to be negative, but it's suggesting we'll stay under 11,712. That should be the top end of this thing. And maybe we can get a little bit beyond that. So if you have the indicators in your wherever, if you're overseas and overnight where you can see this, just look to see what the updates and see if there's any further expansion moving forward. When I talk about expansion, just to cover that, is I have certain words I use a lot. When I mention expansion, that just means the momentum is expanding, therefore the trend is likely to accelerate, or prices are likely to start to move above. So if we get a positive reading on this PPM1, it is projecting that we're going to cross through first and second derivative, this hourly chart again. That means we'll trade likely above that 11,712. And remember, over the next several hours, this thing is declining right now. Actually, it's declining about 17 handles per hour. So we're going to see over the next several hours that the value of this hourly moving average is going to come in, and we're going to be a possibility of easier getting above the 10-period moving average. So the number to get above it won't be 11,700. That's coming down, like I said, 12, 14 handles per hour. So all of a sudden, you're looking at, maybe 17,050 or 75, whatever that calculation comes out to. So that's what I would be looking for there. So let's go to the daily. I just have changed symbol here. Daily is suggesting one more day and then some weakness as we come into Wednesday. So maybe the NASDAQ is suggesting that there will be dialogue out of the Fed that will continue to keep pressure on the markets. Like I said, there's nothing really bullish anywhere to be found. And it's really this value down below the market at 11,500 is about all that we can hope will hold this market. If it breaks below that level, then there's much further numbers down. And in fact, let me go over to the weekly chart here so we can see this and what's setting up here. Weekly chart, like I said, has got some stability. The 10-week moving average, 11,526. So look at 11,500, 11,526 as a downward pivot. If we look at the market grid for the weekly, we're looking at the S1, 11,550. There's the number again right at the 10. Our S2, 11,004. I'll just round these off. 03 is the actual number. And S3 is way down at 11,255. Just looking at that. But it does, what is being indicated as we get closer to the end of the year, the S&P did this, the NASDAQ's doing as well. Looks like there's some downward pressure the last couple of weeks of the year. And like I said, I'll try to do something on Twitter or something when I see this and try to update what's going on from that standpoint. So we'll go ahead and go out to the monthly chart as well on the NASDAQ. I won't be able to go to the quarterly. In fact, the algos aren't. Let me do something here. Yeah, let's go over here. Let me just put the NQs over here, and I'll be able to get the algos on. No, not enough here. So that's the problem. I just can't. Oh wait, bear with me. Yeah, still not enough. There's not enough data to run the algos. I'd have to change the settings. But anyway, everything looks the same. Downward pressure on the 10 on the weekly. That's at. I'm just looking here. 1 second. Yeah, so 11,757. We're looking at 12,000 to 10 is at 12,333. So that's going to be your major resistance on that. So let's go ahead to the Russell. Okay, so let's take a look at the Russell. This is the weekly, so we'll start with the Russell weekly here. Let me change the scale. Same thing. This week is starting to show that we're coming into some weakness right now. PPM1 is at 0.48. Theoretically, and I talked about this, I believe, last week, all of these moving averages, I'm just going to open this up so you can see this. Right here where my cursor is, let me just draw this in because I want to make sure everybody's eyes are focused on the same point here. But this right here where I circled, what this is looking at here is all of the moving averages are very close together. This is a weekly chart. So we're looking at 1818, 1829, 1847, and even the 200. This is weekly, 200 week is in there at 1838. So it's really a weird configuration. If you have a shiny coin, you might want to flip it for which way this thing's going to go. I think this is where I continue to talk about the sideways range what's happening. I mean, these are trendless markets. I mean, good luck figuring out what's going to happen here in the Russell. From a weekly standpoint, this thing is just coiled into something. So it's going to make a move out of here. Right now, everything looks a little weaker, like I said, coming into year end. If I just, let me kill this. If I just go out here on even the, here's the final week of the year, the PPM2 is starting to accelerate down. So everything's pointing at the moment that we're going to finish on kind of a downtick on the year. So that's sort of interesting to think about. Maybe there's year-end tax selling. There's still this stuff going. A lot of folks are talking about maybe last week's decline and some of those couple big days down. That's what we were saying. Maybe it was, but was that all of it? I doubt it. And one of the things that I've talked about quite a bit on this channel is that the markets are still act similar that they have before, but really what we're looking at is that there is so many more market participants, a lot of retail folks, a lot of everybody, and there's so much more access. These, I call them stampede runs, where their markets are, those days we see the 3 to 5% moves. I mean, they're just wave after wave after wave, whether it's up or down. They just keep coming. Market just kind of flattens out, and another wave of selling, flattens out, another wave of selling. So that's just, the Russell is really what we're looking at there. So we're seriously looking at a range bound. And if I go over to, this is weekly, the weekly expectations, just looking at the grid, S1 1778, R1 1815, R2 is 1836. So I would suspect that the ultimate range here for the weekly would probably be S2, R2 on this. So just make note of that. All right, next we'll cover the interest rates. This is the monthly, and I wanted to bring this up tonight. The algos are suggesting more weakness, but being monthly, if I just look at where we're at here, we're going to stay somewhat positive. It won't be until April, how about that, where we start to see some serious weakness where maybe we could come down and print towards a 200. That would be ridiculous, but that's 2.3, 2.5%. What's going to happen during this time is the 21-month moving average is going to continue to advance. Right now, it's advancing at about 10 basis points per month, but it does look like it's losing some of its momentum. So it's going to roll in here. I talked about, matter of fact, let's just go over to the weekly, because the weekly is suggesting that we have some reasonable support right where we are right now at that 348. I mentioned that there was a fib target at 340. We actually hit 340.2, which seemed ridiculous to say out loud, but it's happened. But we look at this is weekly now. We look at the weekly patterns here, and they're just this 10-period moving average overhead is starting to roll over, which tells you the cap is going to be around 382, 375. So any spikes to the upside is going to get probably rejected around those levels. And like I said, I'll try to set up on Thursday night's video. I will get things set up so we can actually talk about where the parameters and some breakout points are, both up and down, so you folks at least have some numbers to look at. Okay, so let's go to the daily just for a second here, just so we can see what the setup is there. When we rebounded off of, so here was the day we printed the 340.2. We got inside day, and then we got to follow through. We're right on the 10-period moving average right now, which is at the 357. I mentioned 352, 358 was a point where we just going back to that moving average. The PPMs are suggesting that we're going to probably hover right around the 10. And so we should see some stability probably over the next couple of days. I did not look to see where we were overnight from the standpoint of the patterns here, but let's just take a. I'm just going to take a quick look here. The 10, yeah, we're at 3.56. We're down just a little bit overnight. Nothing, no big deal. But the patterns that are set up here are suggesting that we should see some movement potentially up toward the 365, 370. That 340 click was probably about it from that standpoint. All right, next we'll take a look at crude oil. And one of the stories that I ran across, they were talking how crude got hammered. Well, the algos are suggesting that a couple more days we're going to see a pretty decent rally in crude. We should ultimately get above the 10-period moving average. That's 75, 73. Probably stay below the 21, but that's going to be your target zone, actually up to about 78. So we should start to rally toward that number. We're down here, just up 0.65 right now, 6.8. So we've got a little bit of a bid in the market, but the algos are suggesting this is the daily that we're going to see more to the upside. Let's take a quick snap shot at the weekly, and I think the weekly is suggesting, I mentioned this 200-week moving average. That value is at 65.72. I don't think we can get there, but we look at the weekly grid that's being projected right now. S1, 68.70. R1, 73.74. We're trading right now at 71. So S1, R1, R2 is 75. I suspect we probably head towards 75. On these weekly numbers, they're going to be the place that you're going to want to pay attention to on those. So you just have to run the market grid numbers with their defaulted values, and you'll be able to get those of you that have the indicators. Okay, next we'll cover gold. And gold, as I'm talking about, I think we're going to consolidate up here around this 40-period moving average. This is weekly, very similar to the 200-day. That's going to be your resistance point. 1820 on the upside. We just look at the market grid. 1823 is R1. S1, 1797. I think we could print maybe an S2 in this week. Probably some downside is potential going down to maybe even a S3, which would be 1760. I think we just consolidate in a sideways range. I talk about this formation, but this is what I call a box formation on the market grid. Everything just squares off. And so that's when we usually get into a sideways range. So it looks like at least this week, probably waffle between that R1 and probably a S2 number. Maybe there's a little more on the downside with the Fed coming out. Who knows what comes out of that meeting. So as I mentioned, the equity indexes look like there's some potential pressure after Wednesday coming into the end of the week. So we'll set all that up as we get closer and we watch the action on Fed Day on Wednesday. All right, next we'll cover Bitcoin. This is getting more interesting. Those of you, I was talking about how negative the algos are getting, and that as we're updating, so all of a sudden those algos were projecting this incredible decline. They're starting to stabilize, and why is that? Is that we've just seen the market stabilize. We didn't get any follow through. In fact, it looks like we have a potential for like another uptick here. And I've been talking about this. I've spent some time on some of these SPF Twitter spaces, and there's some interesting dialogue out there. And it's starting to become more and more obvious, I think, or at least more in the mainstream, that Bitcoin is the real deal, and all these other cryptos have been pretty much a game to be careful with. Even Ethereum has got some issues, but Bitcoin is different than all of them. Everybody's pulling their coins into cold storage. So maybe a lot of this stuff is off the exchanges. So what little is being traded, they're able to bid this thing up a little bit. Just some thoughts on that, because it looks to me that that's what's going on here. But the algos this is the same weekly chart that was suggesting down at the bottom that we were going to a minus 23. Now, a couple of weeks out, we're looking at a minus 4.1. That would still represent a substantial decline, but that's why I was anxious to see, once we came in and we got some updates here, how this algo was going to act. And we're definitely seeing a lot of stability coming back in. No signs of a rally necessarily, but the potential of the downside is dissipating substantially. So it's interesting, because I've talked about some of these numbers that are out there from the standpoint of the downward projections and all that. I think I have the fib ratios off. So this was the downward projections here, 14,418 and 11,722. Those are still valid downside. And a ppm of -4 would be plenty to get us to trade down to that 14,418. And I'm still convinced that the magic numbers in Bitcoin are 15,005, 15,255 range. If we break through that, then that's not a big deal going down to the 14 handle, 14.4. But after that 11.7, that would be pretty substantial. So it's very interesting. We watch these algos as we stayed stable. How many weeks have we? 5 weeks. This is the 5th week of absolute stableness. And I think that's probably the 5th week since the SPF and RTX situation has happened. So we're seeing that actually dissipate. Let's take a quick look at the dailies here, just to get a feel for what this looks like. I'll take off these indicators in a minute, but we do have, this is interesting, upside targets here, upside 18,148. On the downside, there's some short-term stuff that's coming in. The algos on the dailies are suggesting we get a little bit weaker in here, that we should roll over. There's some short-term fib targets, 16,3, 16, trying to get the number, 16,639, 16,341, 16,137 is the pattern that's setting up here. ppm 1 and 2 look like they want to roll over from this level. Okay, so that'll do it for tonight, folks. Yeah, so I'm just looking at a couple comments that you have. Yeah, I'm just, nothing out there. Yeah, SPR is still being drained. Yeah, absolutely. The joke is they're going to sell it all, and we'll see how that all plays out. But yeah, all I can tell you is the Fed probably isn't going to pivot. For a while, it looks like, like I told you, that I'll try to do this week. So you folks remind me to do a yield curve analysis, but I've showed you multiple times here just in closing tonight that the rollover that's happening on the, yeah, I really got going here. I'm about 15 minutes longer than normal. But the entire situation that's going on here is, I lost my train of thought, sorry. But we're just going to see all of this stuff stay in this range. The Fed's not going to change. They still want to do this. The yield curve is going to stay inverted. It may get more inverted, but just looking at the analysis that I was doing, we're probably going to see some stabilization in the 10, and maybe that scenario that I talked about on the front end of this video tonight. If you didn't see it, go back and watch the replay. But the scenario that I'm talking about here is really that the Fed's just going to continue to raise the front end of the curve, get up to a terminal rate 5.2, 5.5, and the back end of the curve will continue to be much lower. And I didn't really go through some of the fib targets, but there's still fib targets for 3.25, even 3% on the 10-year. I don't think those are realistic. Probably 340 print will do it for the balance of this year. We'll see how it sets up. Like I said, we'll be going through this week, and I'll be constantly talking about the rest of the year and what I think the setup is. So thank you, everyone, for watching. I appreciate it. Make sure, if you haven't subscribed, that you do. Tell your friends. Like I said, I've been stuck at 32,000 subscribers for a year. It doesn't fluctuate more than 100 to 150 up or down every month. It's very interesting. So anyway, folks, thank you so much for watching. Just keep spreading the word. There's a lot of things that I'm going to be working on break. So when I come back, we'll talk about it, and we'll see you then. So have a great day trading tomorrow. Hopefully it's profitable. We'll talk to you tomorrow night.